I'm Peter White. Welcome to the Inside Network. Welcome to INDepth. I'm Peter White, and my guest today is Lauren Ryan, Business Development Manager of the Thinktank Property Finance Group. Lauren, welcome.
Thanks for having me, Peter.
Can you walk us through what the business does and how it does it?
Thinktank is a non-bank property lender. We lend to people looking to purchase existing commercial and residential property assets. And the kinds of people that our lending solutions are best suited for are borrowers who are self-employed or derive their income from their business or might have multiple sources of income, or they're looking to purchase a property through an entity. So anything that falls into the slightly challenging bucket for a bank, the non-bank sector usually is able to find solutions for. And with us, our specialty is finance solutions to optimize cash flow, generally for business owners and people purchasing through an entity.
And on the other side of the ledger, you're also a place for investors to park their money.
We do. We run 2 mortgage funds. We obtain the majority of our funding from institutional investors, and those get invested through a debt warehouse. So we have multiple investors in that first mortgage warehouse. And then Thinktank owns the equity tranche, and that's all part of the first mortgage structure. And then the borrower's equity sits underneath that. Our 2 mortgage funds, the Income Trust and the High Yield Trust. One's a first mortgage fund, which has exposure to direct loans, which don't fit into the debt warehouse. And they also have exposure to notes, which are notes in that debt warehouse that I mentioned. And those notes sit above Thinktank's equity. So private investors are protected by the percentage of equity that Thinktank owns in the deal. And the High Yield Trust is a second mortgage facility where we own the first mortgage. Those funds are used for borrowers who purchase a commercial asset, say through their super fund. It's a vacant possession at the time because they're going to move their business into it. Once they move their business into it, they can reclaim the GST from the ATO. The problem with that is that once the funds get returned to them through their super fund, the money's trapped in the super fund. So we can offer them that GST loan so that they can A, protect their capital from getting trapped in the super fund, and or B, if they have already contributed their max contributions in that year, they can't contribute any more to pay the GST. So we can offer that loan. We also have a top-up loan, which is essentially a bridging finance for a short term for borrowers who need a little bit extra capital. We don't charge early repayment fees on either the GST or the top-up loans, which encourages borrower to pay it down sooner, which is beneficial to the investors because when you're lending at higher LVRs, duration is an added risk. So we find that borrowers pay down within 6 to 12 months, which aligns with our minimum investment term of 12 months for investors. And investors in the High Yield Trust also invest in notes in our debt warehouse.
What about investors, just the ordinary mum and dad investors? Do you have many of those, or is it primarily institutions and super funds?
In the private trusts, we have quite a few mum and dad investors. We can only accept high net wealth and sophisticated investors at this time. So we do need investors to provide us with that accountant certificate as determined by ASIC to confirm that they meet their high net wealth status. But a lot of the investors that I deal with day to day are retirees or people gearing up towards retirement, looking to supplement their income.
So what's the minimum investment?
Minimum investment's $10,000. So we start small, let people start small and build up as they see fit. And a lot of our terms are similar to what you might find with a retail fund. It's just that we need that high net wealth certificate there.
And what would you say some of the misconceptions, common misconceptions about the non-bank sector?
I think a lot of people, at least what I'm hearing, is people think bank is good and non-bank is bad. And that's definitely not our experience. Over the years, regulation has made certain types of loans quite expensive for the banks to write on their own balance sheet. And the non-bank sector has grown quite rapidly off the back of that change. The banks have also spent quite a lot of resources in developing automated credit servicing systems, which means that if you don't fit into that model and there's a touch point, which means that someone has to get involved, there's an added cost to that. Now, if you're writing a $20 million residential property in an affluent area, then it's probably worth the banks to do that deal for you and work through those complexities. For a $650,000 commercial property loan, it's probably not quite worth the time and the cost, because the cost of the person actually doing the assessment is quite expensive, and the banks have to hold tier 1 capital on their balance sheet, as you know. With the non-banks, we're not a bank, so we don't have those same capital requirements, and we can work through each deal because every deal is different, because we're dealing with quite sophisticated.
Speaking of that, can you explain or talk through a typical borrower, a typical deal?
Yeah, most of our borrowers are, as I said, people who derive their income from their business. So they're self-employed, or they want to purchase through an entity like a self-managed super fund, or a trust, or a company. So a typical borrower might be, say, 2 PAYG trustees looking to purchase a residential unit through their super fund, or a tradie looking to purchase a commercial unit to store their stock. And that's
a typical size. Is there a typical size?
Our maximum loan size is 3 mil. So we do write loans at the higher end, but our average loan size is 650. And with the average loan to value ratio in the portfolio of 65%, you're looking at assets around the $1 million mark. Now, if you think about if people are looking to downsize, and we saw this during COVID, especially in the commercial space, people are looking to downsize their offices. You downsize to small ticket, which is a space we play in, or you go home. And people went home, and then they realized that wasn't going to work for them, but they don't need an office of more than, say, 5 to 10 people. So we saw a lot of acquisitions once lockdowns ended of professionals purchasing office suites so that they had somewhere to work and somewhere to house their staff who they didn't need.
So you've actually been at the coalface of a sociological change to some extent.
The time that was COVID and the reason why is unprecedented, but there's always shifts in the market that drive people's purchasing power and drive people's purchasing choices. We just saw it from that small ticket commercial side, whereas...
Close up?
Yeah.
What are the 3 most important considerations for somebody considering investing in a mortgage-backed investment?
Yeah. The big thing with private credit and any private investment is the lack of liquidity. So the first thing I'd say to the investors is, are you comfortable with the fact that your money is tied up for 12 months? Now, that's not to say that you can't get your money back in that 12 months, because that is possible. But of course, liquidity is something that everybody wants all at the same time when markets collapse. It's not something that you necessarily want to use, but when you need it, you want to be able to have it. That could be, in the worst case scenario, that there is always the risk that banks, non-banks, private funds would struggle to meet all redemptions if everybody wanted to redeem all at once because something had happened in the market. And that risk is present with Thinktank and many businesses that look similar. Once you get over the liquidity hurdle, the next step is, are you comfortable with the type of credit that Thinktank writes, the equity that we take in the deals, our track record over multiple cycles, and the income that we generate? Are you comfortable that is a commensurate return to the risk that you're taking, and that the people at the top making the decisions have got skin in the game, and that they understand how to manage a credit portfolio while still writing new credit and managing credit during what is a relatively volatile time?
What about people wanting to keep their money longer than 12 months? Is that possible, or is it automatically got to be cashed in after 12 months?
No, people can invest for as long as they like. It's a minimum 12 months to start. And often the conversation I get is from new clients until they get to know us and get to like us and get to trust us. How can I get my money back if I need it? And that if very rarely eventuates into a I do. And often we see people investing with us for quite some time, and they invest in multiple entities. So very similar to most investor,
And the returns paid annually or quarterly or?
Monthly.
Monthly,
yep. So we charge the borrower monthly. Investors get paid monthly, or they can reinvest. It's entirely up to them.
Is there such a thing as a typical investor in Thinktank? And where do you think that an investor's money in Thinktank fits within a portfolio?
The typical investor is people gearing up towards retirement, looking to supplement their income, their working income from income earned by their investors. We are a purely income fund. There's no alpha. There's no capital growth. You invest $100,000 today, you earn income on that monthly. You get that $100,000 back at the end end of 12 months or whenever you'd like it back.
And today, what would somebody expect if they put $100,000 in today?
The income trust is returning 7.41% per annum paid monthly, and that is and the high yield trust is 10.31% per annum. With the cash rate rise yesterday, we expect that those returns will increase by about 25 basis points on Tuesday when we reset our rates. So there's a variable component to the return, which is the BBSW 30, the Bank Bill Swap Rate 30 days. That's reset on the 10th of the month or the following business day. And we do that to allow for any RBA changes throughout the first week of the month.
Thank you very much, Lauren, for your time.
Thanks, Peter.